They called it America's most innovative company 7 years running. Fortune magazine couldn't stop praising them. Wall Street worshipped them. Then, in 24 days, $74 billion vanished and 20,000 people lost everything. This is Enron, the company that didn't just cook the books, they invented an entirely new recipe for fraud. Houston, 1985. Two pipeline companies merge. Boring stuff, natural gas distribution. The kind of company your dad would have called steady. Kenneth Lay becomes CEO and immediately sees something nobody else does. Energy isn't just a product, it's data, and data can be traded like stocks. He hires Jeffrey Skilling, a McKinsey consultant with an idea so radical it should have been illegal. Spoiler alert, it was, but they did it anyway. Skilling walks into Lay's office with a proposal. Stop being a pipeline company, become an energy bank. Don't just move gas, create markets for it. Let companies hedge risk, speculate on prices, trade contracts like currency. Lay doesn't just approve it, he makes Skilling chief operating officer on the spot. What neither of them mentions is that this only works if the numbers look perfect, every single quarter, forever. 1992. Enron gets approval from the SEC for something called mark-to-market accounting. Sounds technical, incredibly dangerous. Here's what it actually means. Normally, you record revenue when you get paid. Enron could now record the entire projected profit from a 20-year contract the day they signed it. Sign a deal today, claim 20 years of income immediately, even if you haven't delivered a single thing. A quick example. Enron signs a 10-year contract to supply energy worth $100 million. Under normal accounting, they'd record revenue gradually as they actually deliver. Under mark-to-market, they book $100 million profit today. The problem? If the deal goes bad, if costs rise, if the client backs out, that phantom profit evaporates. But by then, executives already got their bonuses based on fake earnings. Wall Street loved the growth. Stock price rockets from $20 in 1990 to $90 by 2000. Enron becomes the 7th largest company in America. Skilling's on magazine covers. Lay's having dinner with presidents. And inside the building, accountants are panicking. Because the contracts aren't performing, costs are higher than projected, clients are defaulting, real losses are piling up. But admitting that would crash the stock, trigger investigations, end careers. So they make a choice. Hide everything. They create something called special purpose entities. Sounds boring, purely evil. These are fake companies, technically separate from Enron on paper, secretly controlled by Enron executives in reality. Enron would sell its bad assets to these entities at inflated prices, book immediate gains, and bury the losses off the main balance sheet where investors couldn't see them. Andrew Fastow, Enron's chief financial officer, builds hundreds of these entities. He names them after Star Wars characters. Jedi, Chuko, Raptor. Not a joke, actual names. He personally profits $30 million managing these fake companies while simultaneously serving as Enron's CFO. The conflict of interest is staggering, and everyone at the top knows it. Fastow creates one entity called LJM, named after his wife and kids' initials. Enron sells assets to LJM at fake valuations. LJM is funded by outside investors who think they're investing in a legitimate Enron partnership. They have no idea they're just bag holders for Enron's hidden losses. When deals go south, LJM eats the loss. Enron's books stay clean. By 2000, Enron's hiding billions in debt. The stock's at an all-time high. Skilling becomes CEO. Lay remains chairman. They're untouchable. Except someone inside is starting to ask questions. Sharon Watkins, a vice president in Enron's finance division, is reviewing some of Fastow's partnerships. The numbers don't add up. She digs deeper, finds assets valued at prices that make no sense, discovers entities backed by nothing but Enron's own stock. She realizes what's happening. The whole thing is a house of cards. If Enron's stock drops, the entities collapse. If the entities collapse, the hidden losses appear. If the losses appear, the stock crashes. It's a death spiral waiting for a trigger. August 2001, Watkins writes a letter to Kenneth Lay. She doesn't send an email, writes an actual letter. I am incredibly nervous that we will implode in a wave of accounting scandals. Lay reads it, calls a meeting with Enron's law firm, asks them to investigate. They do, sort of. They interview Fasto, who obviously says everything's fine. They don't examine the entities closely. They clear Enron of wrongdoing. Lay files the letter away. 3 months later, everything Watkins predicted comes true. October 16, 2001. Enron announces a $638 million loss. Third quarter earnings, worst in company history. Wall Street freezes. Analysts start asking questions Enron can't answer. Where exactly are these losses coming from? What's inside these partnerships? How much debt is really hidden? Skilling already resigned in August, claiming personal reasons. Now Lay's back as CEO, doing damage control on CNBC. Our business model has never been stronger. We have the finest organization in American business today. 2 weeks later, Enron admits it overstated earnings by $586 million over 4 years. The SEC opens an investigation. Stocks at $15, down from $90. Employees are panicking because their retirement accounts are locked in Enron stock. They're watching their life savings evaporate in real time and legally cannot sell. Meanwhile, executives were cashing out months earlier. Lay sold $70 million in stock while telling employees the company was sound. Skilling sold $15 million. They knew. The partnerships start imploding exactly as Watkins predicted. Entities backed by Enron stock become worthless as the stock crashes. Hidden debts surface, $38 billion in liabilities that were never disclosed. November 8th, Enron admits it's been lying for years. Restates 5 years of financial statements, admits the partnerships were fraudulent. Stock drops to $4. Credit rating agencies downgrade Enron to junk status. No one will lend them money. The company's dying. Dynegy, a smaller energy company, offers to buy Enron for $8 billion as a rescue. Due diligence begins. Dynegy's accountants look at Enron's actual books for the first time. They find billions more in hidden debt, contracts valued at fantasy prices, assets that don't exist. November the 28th. Dynegy walks away. Deal's dead. December 2nd, 2001. Enron files for bankruptcy. Largest corporate bankruptcy in American history at the time. 20,000 employees lose their jobs overnight. Their 401k retirement plans, invested entirely in Enron stock, are worthless. $2 billion in pensions gone. Many employees lose everything. People who worked there for 20, 30 years. Retirees who thought they were set for life. One day they had retirement. Next day, nothing. Shareholders lost $74 billion as the stock went to zero. Institutional investors, pension funds, regular people who trusted the ratings, the audits, the executives on TV. All gone. Arthur Andersen, one of the big 5 accounting firms, had audited Enron's books and signed off on everything. As the investigation heats up, Andersen employees start shredding documents. Tons of paper, hard drives wiped. They destroy so much evidence that the shredding machines break. Andersen's convicted of obstruction of justice in 2002. The conviction's later overturned, but it doesn't matter. The firm's reputation is destroyed. 85,000 employees worldwide lose their jobs. An accounting giant that survived since 1913, gone. The trials begin. Andrew Fasto pleads guilty, gets 10 years, serves 6. Jeffrey Skilling's convicted on 19 counts, fraud, conspiracy, insider trading. Sentenced to 24 years, serves 12. Kenneth Lay's convicted on 10 counts. Before sentencing, he dies of a heart attack. His conviction is vacated. He never serves a day. The government can't seize his estate to compensate victims. His family keeps millions. Enron didn't just fail. It revealed how completely broken the system was. Executives lied. Auditors enabled them. Analysts promoted the stock while knowing it was garbage. Banks helped structure the fraud. And every regulator missed it until it was too late. Congress passes Sarbanes-Oxley in 2002. the biggest overhaul of corporate accounting laws in decades. CEOs now personally certify financial statements, auditors face stricter oversight, penalties increase, but laws don't change human nature. In 2008, the financial crisis proves that again. Different industry, same pattern. Executives chasing bonuses, hiding risks, regulators asleep. Enron was supposed to be the wake-up call. Instead, it was just practice. The smartest guys in the room weren't smart. They were just willing to lie longer than anyone expected, and thousands of people who believed them paid the price. Enron's collapse wasn't just about corporate fraud. It was about what we choose to celebrate. Innovation became the excuse for breaking rules. Confidence was mistaken for competence. And when employees asked questions, they were told to trust the vision. The warning signs were everywhere, but everyone was making too much money to care. 20 years later, we still haven't learned the lesson. We still worship growth over sustainability, charisma over integrity, stock price over actual value. Enron didn't just fool investors. It fooled an entire country into believing that rules don't apply when you're successful enough.